investors are being rational in terms of where they're putting their money, rather than irrational, which is often a definition of bubbles. Welcome to Key Points for February. This month we take a look at what could be a decisive Japanese election. We do not believe in the demise of the US dollar. And we take a look at the divergences in equity markets and what this could mean for the bull market going forward. Now, turning to our first point, Japan has become very un-Japanese in recent months. We've seen inflation pick up and we've seen a cost of living crisis in Japan develop. We have a new prime minister and now she's calling a snap election on the 8th of February. So what could this mean? Well, clearly she's looking to consolidate her position and that of the LDP, and we're expecting her to implement further fiscal initiatives, perhaps around tax cuts and food, but also other fiscal elements coming through as well. And to some extent that is disconcerting for the bond markets. If you look at the chart I'm showing you here, you can see Japanese government bond yields have been moving higher in recent times. Again, they had been very low in years gone by, but now we've seen a bit of an inflection point. Fiscal spending at a time where Japanese debt to GDP is 240% is a bit of a concern to the markets. Now, ultimately, we think these bond yields are likely to go a bit higher. If the Prime Minister wins, as the polls suggest she will, there's likely to be a bit more fiscal spending coming through, but ultimately we think that will be capped because the cost of funding that debt will simply be getting too high. So we are expecting bond yields to pick up probably towards the 2.8% level, but that is likely to constrain some of her ambitions. Importantly, we're more hawkish in terms of what the central bank does. We're expecting 2 further rate hikes by the Bank of Japan, and that should also help to support the currency. The yen has been very weak, and we are expecting that to appreciate a bit in the months and quarters ahead. Now, turning to our second point, we don't believe in the demise of the US dollar as a reserve currency, as some of the press headlines would suggest. Yes, it's been a little bit weaker of late, but broadly speaking, we think we're around fair value. If you look at the chart I'm showing you here, you can see that most of the decline in the dollar came in the first part of 2025, where it fell about 10%. Since then, it's largely moved sideways, although we have seen a little bit weakness in recent weeks. But even there, you can see we're only back to the levels that we have been trading at for a number of years. And as I said, we think it's close to fair value. And indeed, as we look forward, US growth is actually pretty strong. We've got the big, beautiful bill providing fiscal stimulus in the first half of the year. And as a result of that, we actually think the Federal Reserve is only likely to cut interest rates perhaps only once towards the middle of the year. Now, all of that should support the dollar going forward. So yes, of course, it can be wobbly at times, but as you can see, volatility hasn't been that high, and we do believe we're at that fair value. So we are expecting the dollar to trade pretty much sideways going through the remainder of this year. Now, turning to our third point, as I mentioned last month, we believe that the divergence we're seeing in some equity markets is really quite encouraging. Globally, stocks have continued to rise, supported by, again, good monetary and fiscal policy and the tech boom that we're seeing. And although I mentioned last month that we're seeing divergences within the US market, we're also seeing divergences globally. If you look at the chart I'm showing you here, this is focusing on the tech sector, which of course is still very much in vogue, but you can see there's a differentiation clearly here. We've seen companies like SAP recently reporting numbers here, struggling somewhat. It's down about 27% since October. But on the other hand, some of these Korean tech companies have been booming, whether it's Hynix or Samsung. You can see these are up the best part of 100% over that very short time period. So investors are selecting the stocks they like, the ones with the better business models. And as a result of that, we think this is encouraging. It certainly shows that investors are being rational in terms of where they're putting their money, rather than irrational, which is often a definition of bubbles. So we still believe we're in a boom phase for equities, although we have to point out that during the midterm election year in the US, usually there is more volatility, and we have to be ready for that. But broadly speaking, the fundamentals are still good. We see the rotation as a positive, and we still see further upside, even if it is a bit more volatile for global equity markets. Now remember, as always, you can read the full report on Zurich.com, and I look forward to seeing you again very soon.